Good morning and good afternoon, everyone. My name is Andrew Lin, and I'm the Managing Director of Infrastructure, Power, and Utilities, and that's within the Global Corporates Group of DBRS Morningstar. I'm also part of the ESG Methodology Committee at DBRS Morningstar, and one of the co-authors of our ESG criteria. Today, we're going to be talking about ESG from a credit risk factor point of view. And the presentation will be probably about 20-25 minutes, 30 if I can really stretch it out. And at the bottom of your screen, you should see some option there if you would like to ask questions. That will go into my question box, and then I would be happy to answer those questions at the end of this presentation. So let's get started. So ESG is a big hot topic right now, and whether you're reading the Wall Street Journal, the Financial Times, or the Globe and Mail, ESG pops up a lot. And in the context of investing and the financial industry, what exactly do they mean when they talk about ESG and you see all these articles that are coming up? Typically, usually, the vast majority of the time, they're talking about sustainable debt. And when they talk about that, what that means when they say sustainable, is they're talking about uh, responsible investing, or they're talking about ethical investing. And so I meant both on the debt and equity side. And they usually throw up a big graphs like this. And this is a sustainable debt issuance graph that shows you how immensely popular it has been over the past few years. And the growth of sustainable debt has been really quite strong. Now, that said, sustainable investing is not a new concept. It has been around for decades in various forms. In fact, you can think about it in terms of another iteration of socially responsible investing that a lot of the large investment funds have had over the past couple of decades. And back then, the concept of SRI was really more about a filtering process, not investing in things that are, say, vices like alcohol or tobacco, or things that are more controversial like gambling or guns. Back in the 80s and 90s, a lot of funds didn't want to invest in apartheid era South Africa. SRI was also part of the trend for activist investing. So when funds wanted to actually make changes, as opposed to walk in with their money, they would actually vote strategically in support of certain initiatives. For instance, labor pension funds would actually, and still do, actively promote or support companies that are pro-labor. Now, with ESG, though, it takes it one step further. It makes these type of sustainable concepts available to all types of investors, and it quantifies these concepts into different buckets, up to maybe 20 different buckets on different aspects of the environmental side, the social side, and the governance side. But basically, all of this has the same concept of trying to overlay non-financial concepts onto the typical um, uh, the typical strategy for profit maximization or minimization of risk. And it talks about, or it's trying to understand for the investor how to choose investments that will essentially make a better impact on the world through ESG investing. So it really talks about how can I be more responsible, how can I be more sustainable, how can I think more ethically with respect to my investment dollars. So that is typically what ESG is about. And it's not what we're talking about today. Now, I did feel though that I needed at least a couple pages here to actually present to you what is the most common view of what ESG is compared to what we're going to be talking about today. So look, if that's not what you were thinking about, I won't be offended if you drop off. But we are going to be talking about ESG credit risk factors today. So most importantly, then, it is quite different from the sustainability side of ESG. And the best way of thinking about this is whereas ESG sustainability factors focus about how a company impacts the world or society at large, ESG credit risk factors are more inward looking. It's more about how uh, we look at how the world or society impacts the company itself. You can say that it's a bit self-interested. It's a way of looking inward towards the company. Uh, but that is what a credit rating agency does. It looks specifically at how all factors impact a company. So think about it in terms of those same ESG concepts, those ESG themes, but more about the impact on, let's say, the operations of the company, the infrastructure of the company, all from a financial point of view. So think about it more of the costs then, and does it affect the solvency or the credit strength of these companies? Again, we're looking at it more from the debt point of view as opposed to the equity. Um, and the other aspect, though, is the company actually taking active steps to mitigate those future effects, those potential adverse effects, whether they be more climate related or other types of ESG factors. Here's an example: climate change. ESG sustainability, when we think about climate change, it's talking about how that companies may impact the world, and therefore it's looking at the company's carbon footprint and what actions it's taken potentially to mitigate that carbon footprint. Well, the flip side of that is really climate change causing more volatile weather patterns, rising sea levels, the heating of the earth. And when we think about ESG from a credit risk factor point of view, we're looking about how uh, that environment in terms of global warming and volatile weather is affecting the company. Whether it's affecting rising sea levels, affecting potentially erosion of its properties, of its assets, and how does it try to fortify those assets to withstand that? So I mentioned that DBRS Morningstar does have an ESG criteria. Criteria is essentially a methodology that we've created, and it maps out then uh, about 17 different factors that span from the environmental side, social side, and governance side. And those of you who are very much on, have read up on the sustainability side of ESG will recognize these same words because they are pretty much the same themes, the same topics. But again, it's really about how we interpret those words and those topics as opposed to having an impact on the world. We're looking at about how it has an impact on the companies themselves. So again, same words, same topics, but how we interpret them is different from a credit risk factor point of view. So as an example, the E side is quite big, and as an example, the emissions influences waste is really talking about pollution, not so much how the company is polluting the world, but it's looking more than on the financial side and looking at the costs of a particular issuer and what are say its costs in terms of the disposal cost of that type of waste. Is it expensive? Are they being penalized if they do something that may not be very environmental? Another example is carbon and greenhouse gas emissions. Again, not so much looking at specifically the direct action of the company, like a coal plant, actually causing greenhouse gas emissions, but looking inward at what the costs are to that plant because of that. So, in a lot of jurisdictions, uh, they would be penalized. They would have to pay extra for carbon credits in terms of offsetting that type of emissions. Climate and weather risks, same sort of concept here, as I've mentioned, about storms and volatile weather. Let's say it's a tourism type company, a lot of different destinations, but there's more volatile weather that kind of shuts down a lot of its operations, more so as time goes on. The social impact of products and services, that's a little bit more esoteric type of concept. But again, it's more about how society, then the changing tastes or patterns of society are really impacting then uh, the, uh, uh, the company themselves. Bribery, corruption, and political risks all on the governance side. Again, that's tending to be more about impacts of those actions and how it would impact then the company, its board, and therefore ultimately having a financial impact on it. I want to talk for a minute about materiality because certainly what I said before about impacts inward is important. But the size of that impact is also quite important because not all things are material. And when we, as a credit rating agency, look at all the different factors that impact that particular issue, and when we assess that ratings, the rating of that particular issuer, we are looking at the key factors. And sometimes there could be a handful of them, half a dozen of them that are really big and significant. And they're the ones that we say are notch worthy, that will actually move the rating or actually determine the rating. And so you can see here that a lot of the key business attributes will really be quite instrumental in terms of determining the rating, whether it be more the competitive advantage, the kind of products and services that it provides, its size, whether it has a critical mass and diversity within its markets, its overall market share and its dominance. And then from an operational point of view, just how efficient and what sort of margins it has. And the flip side of that then is the financial factors. So we take a look at the all its financial statements, the income statement, balance sheet, and cash flows, and then really then to have an impact, we're really looking at saying what are the changes at the revenue side, the revenue line, the operating expense line, and then on the balance sheet, what sort of debt leverage it has, and looking at ratios like debt service ratios, coverage ratios, looking at in terms of its options, what sort of refinancing option it has, and liquidity. So in that particular context, think about that. These are the big factors that actually a credit rating agency looks at. So when you think about ESG factors and those impacts, granted they are inward impacts, the materiality aspect of it is important. We take a look at ESG credit risk factors alongside with a whole bunch of other different factors. And so the same level of materiality that we place on the uh, non-ESG factors is the same level of materiality that we need to assess when we take a look at these ESG credit risk factors. So I guess my point here is that uh, just because those ESG factors are there, and even though they are inward looking, a lot of times, though, they may not be big enough to actually move the rating or even have uh, an impact that is less than notch worthy, but not material. So, and this may not be intuitive because a lot of times these ESG themes are actually in the media a lot. They are high profile, but just because they're high profile doesn't necessarily mean that they will have a material financial impact. So here's an example. This happens from time to time when you have a large multinational oil company. It has an oil spill somewhere. It's in the news in terms of the cleanup and impacts on the environment. Uh, but in the big scheme of things, it may not be material from a financial point of view. A lot of times, the big oil companies, because they make so much money, it's really a drop in the bucket. Or insofar as they actually have reserves already set up aside, or they have insurance already set up aside, it's fully mitigated. Another example is insurance companies. We hear a lot about global warming and the impacts of increasing hurricanes and the 100-year storm now coming every 5 or 10 years. And therefore, you would expect that the claims on that are put towards the insurance companies would hurt them financially. However, if the insurance company can actually mitigate themselves or insure themselves or immunize themselves from these particular events, then from a financial point of view, it may not be material. to their bottom line. So for instance, if the concept of exclusions that they have, if there are more exclusions within their policies, such that effectively they don't have to pay because of that, and there are exclusions, more and more exclusions in certain hurricane or flood-prone type areas, then it gets them out of it. The other way that they can mitigate that is through higher premiums that they can pass on. And if that actually, from a statistical point of view, is sufficient for them to balance out those extra costs, then they're good as well. Another example is would be regulated utilities. And if there's a regulated utility that has a bunch of costs that is imposed upon them to actually transition to a low carbon operations, typically a regulated utility is allowed to pass on these costs to the rate base. And therefore, if there's a flow through effect then of actually passing on these costs, and they have a regulatory regime that allows them to do that effectively and timely, well, then it's not really material then, or it has become immaterial to them. And therefore, we as a credit rating agency, when we're assessing that particular risk and we're trying to determine if that's a impactful ESG credit factor, we can reason then that it's there, but it's not a material ESG credit risk factor, and therefore we don't highlight that. Okay. Now, up until this point, I've been talking about the ESG credit risk factor. Well, what about ESG sustainability factors? Well, sustainability factors are inherently non-financial, and therefore, as a general statement, they have little impact from a credit risk profile. Now, I will return to this concept later on, uh, but I'm just going to say, in general, sustainability factors don't have much of an impact on the credit profile. Okay, so let's just go through some of these examples, and that can better illustrate these particular concepts. And let's talk about certain factors and some examples. So on the emissions, effluents, and waste, what if there was a company out there, manufacturing plant, where it does, as a byproduct, have a whole bunch of waste products? And what if it was in that particular jurisdiction where they are legally allowed and they conform to all these regulations to actually dump that waste into a big hole in the forest? Well, actually, from a sustainability point of view, that's not good. You can't say that's good because you're putting toxic waste into a green, pristine environment. But from a financial point of view, it's actually neutral. I mean, that is what they would be doing as the most efficient way of doing that. In fact, if it's the potentially most economical way compared to a bunch of alternatives, it could potentially even be positive compared to if they were to have to dump it or dispose of it elsewhere. Carbon and greenhouse gases. Let's say the company voluntarily reduces its carbon footprint, and they get great kudos in social media. They get news articles written about that. It's generally positive from a sustainability point of view, but it's actually neutral from a credit risk point of view because it really doesn't do anything to for the company in terms of its financial impact. In fact, if it costs them a lot of money to do that, it could actually be potentially negative if it's expensive. Climate and weather risks. Like I kind of mentioned this before about violent weather, rising sea levels, and how it erodes the company's infrastructure. Um, so you can see that all of those aspects, it would be hurting its assets, it would be degrading its assets, the value of its assets, uh, clearly negative. Um, Now, that's assuming that it has to pay for that. If it already has insurance and it's again mitigated through other means, then potentially it's neutral. Um, Now, from sustainability point of view, um, when it's the fact that it's uh, rising sea levels and that it's all bad. But from the viewpoint of sustainability, if the company is not really, it's really being affected by it, it could be perceived as neutral. Um, the social impact of products and services. Let's say that company is giving away products for the less fortunate. Uh, Definitely from a sustainability point of view, it's ethical, it's responsible, it's positive. It doesn't really do anything to the company from a overall business point of view, so it's neutral. In fact, it could potentially be negative if the cost of giving away those free products means that it has foregone revenues, significant foregone revenues. Again, there's a materiality aspect of that. Um, Human capital, human rights. There's a couple of different concepts in there. Let's say the company implements DEI in its HR policy, so diversity, equity, and inclusion. Definitely positive from a sustainability point of view, but really from a credit risk point of view, it's neutral. Now, there's a lot of debate going on there about how DEI can actually enhance the operations and the profile and therefore the business and the revenues of the companies. I think that this concept and this theme is still early, and therefore there's not a lot of empirical data yet on the benefits of doing that and whether it has a material financial impact. So again, we go back to the concept of materiality. And maybe in the future, there'll be a lot of data to show that it really does have a significant impact. But currently, based on the data that we can see, it is neutral. Okay, so let's go back to just talking about impacts inward. And we at DBRS Morningstar, we are credit analysts. We have our colleagues over at Morningstar Inc. On the equity research side, who also take a look at ESG. Then they take a look at it also inwardly on how it affects the companies that they're assessing in their research. But equity research analysts and credit analysts, they are similar in terms of looking at ESG in similar ways in terms of looking inward about how ESG actually affects the financially impacts the company. There are differences, though, in how we assess that. And equity analysts, I would say they have a wide variety of different factors that they can look at, whether they are a wide variety of ESG factors or a wide variety of non-ESG factors. And the different types of impacts can be small or large. When you think about the sum of the parts type of analysis in fundamental analysis, every little bit adds up to the sum. And therefore, there's probably more gradations of impacts that they can take a look at. They have possible growth scenarios, different scenario analysis that can be expensive, and the time frame can go out further or even out into perpetuity. Credit analysts, from a relative point of view, you could see as looking at it in a shorter time frame than fundamental equity analysts. Because really, we're looking at the probability of the company honoring its debt obligations. Can that company comfortably repay its interest and pay its interest and principal on time? Will that company stay solvent over the long period of time? The other aspect is that debt holders and equity holders are different levels of the capital stack, the capital structure. And therefore, they could have different priorities, which may actually lead to different views of the same factor, including ESG factors. So let's take an example here. So we have a large multi-year capital expenditure, and it's really meant to fortify or adapt a company's infrastructure for greater uh, environmental issues, volatile weather. We go back there again, and as one of the byproducts, it makes it more energy efficient. So whether it be the buildings where they're doing retrofits for efficiency, or it's more about along the bank of a sea or an ocean, trying to raise those particular banks for flooding. If these costs are expensive, but they put the company on a stronger footing over the long term. That's all positive from an equity point of view. From the debt point of view, it may or may not be, and it could actually be potentially negative if all of these capital expenditures are actually debt finance, and then that debt financing then has an additional debt servicing burden over in the short term. And so there you can see the differences where the equity investor and the debt investor may have a little bit of a different outlook. This should not be surprising because this happens outside of ESG as well. When we're talking about the use of specific funds, whether it be for repayment of debt versus a special dividend for equity, it happens all the time that the equity holders and the debt holders may have conflicting viewpoints. Okay, so this is a very popular question: is can ESG sustainability factors also be a credit risk factor? Um, and the answer is yes, sometimes. But when can that actually happen? Well, think about the concept of these impacts outward, which is how we define ESG sustainability factors. But think about these outward impacts then having a feedback loop and then having an impact inwards. And it's really this feedback loop, this boomerang impact here, where we would start to say, okay, these sustainability factors can also be a credit risk factor. Remember we talked about sustainability targets on a voluntary basis. And typically we say that if they did that voluntarily, typically doesn't have a credit risk impact. However, if those sustainability targets are actually enforced, either legally from a regulatory point of view, or there are other type of financial penalties. And the second part of this, that second bullet point then, is that such penalties should be materially sizable. It should have a financial impact. If it checks both those boxes, then actually, yes, those ESG sustainability factors can have an impact as a credit risk factors. The flip side of that is also true, where if you're meeting certain sustainability targets and it results in savings in other ways. So let's say that it was a refurbishment of an old building, which actually cuts the heating costs in half. Well, that could actually save a lot of money. Now, if the overall heating costs from an overall viewpoint of the inputs, the overall inputs and costs of the company are quite small, it doesn't really matter whether you actually cut it in half because its overall impact and the overall costs are not material. So that second aspect is that the savings are financially material. That is important. Here's some examples. We kind of touched about this a little bit. A power plant. It has rising costs. It is then forced then to, as part of a carbon trading scheme, that it needs to buy carbon credits. So before, when it was just emitting greenhouse gases, really not much of an impact. You overlay now a national carbon trading system, that is that feedback loop where now it is having a financial impact and therefore becomes a credit risk factor. Sustainability linked bonds is another interesting concept where the financing of a specific bond or debt instrument, the interest rate will actually change then depending on whether sustainability targets, KPIs, have been met. And so whether it's success or failure, then will change the future interest rate on that particular debt instrument. Board governance, and this is a topic that has come up on a number of occasions. DEI representation currently is voluntary in the vast majority of cases. There is a trend now with some stock exchanges where they are requiring disclosure of DI representation on their boards. This is no longer voluntary. It is a mandatory disclosure. However, there is actually no material impact if you disclose that you don't have good DEI representation. Um, Now, the trend, though, potentially in the future, is that it could become a requirement from that national stock exchange that if you don't have adequate DI representation on your board, then you may not be able to be listed. And if it goes in that direction, and once it does happen in that direction, you can then see how that DI representation, how it was originally a sustainability factor, could then become a credit risk factor. Because then, obviously, if they can't list themselves, then it would be a material impact. Okay, so let's finish off with two case studies. And the European Union has an emission trading system. It's been around for almost 20 years. And gradually, over time, since 2005, it has increasingly incorporated more participants into the trading system. And it has made it tougher for those participants to achieve those credits over time. So they've slowly implemented it so that they reach higher and higher targets. And currently, the EU's ETS system has about 11,000 participants, which happen to be factories or power plants or other type of companies that are energy intensive. And it covers an economic area of not just the 27 EU states, but also Iceland, Norway, Liechtenstein, and the United Kingdom. And it's based on a cap and trade principle, which means that uh, there's an overall cap, and then each one of the participants are given a certain number of credits, and then their carbon footprint is assessed, and therefore the credits are used against that. And insofar as they exceed that particular credit allotment, they need to buy in terms of buy credits from other participants, or they need to reduce their carbon footprint. And over time, the amount of carbons in the overall amount of carbon credits within the system is being decreased, and the number of participants is being increased into the system. And therefore, you can see then that maybe back in 2005 or 2010, it wasn't a big deal for companies that exceeded their cap to just go out and buy extra credits. It wasn't that much. But as the supply and demand becomes more imbalanced and the number of credits are lowered, it behooves these companies then to either pay up for them, which can have a financial impact, or it requires them to actually find ways of reducing their carbon footprint. And that could have a financial impact in terms of, again, upfront capital expenditures, and therefore potentially debt financing those type of capital expenditures. And here's an example of what has happened over the years. And you can see the line of the pricing for the carbon credits. It was fairly stable from the 2010s, and then actually around the time of the start of the pandemic, and especially over the past year, you can see that it's really stepped up. And these are through moves by the EU as they enhance the system, as they bring in more participants. There's something called the Fit for 50 as well, where again they're trying to reach a net zero environment for all of the EU. And therefore, because of that, you can see that it's only going to go up in terms of these costs. So even though it may not have been a material credit risk back then, it could potentially be a potential credit risk for those participants going out into the future. Let's talk about sustainability-linked instruments. And I talked about this before, and this is where it's actually linked. Their finances is actually linked. I want to differentiate that between sustainable debt, because sustainable debt doesn't have that link. It's more about allocating the use of proceeds for specific debt issuance. And the entire green bond market is based upon that. It's about how you use those bond proceeds and making sure that they go into sustainable or green or environmental type of projects. Now, uh, and hopefully that happens. Hopefully they actually do that. Well, a sustainability linked bond though is different in that there are KPIs for the company to reach, and if they do reach them, that's great. Either their rates go down or it stays the same, depending on how it's structured. But if they don't reach them, the rate could go up. And the sustainability linked market is one of the fastest growing areas, as you can see from this particular graph here. Just over the past few years, it's grown tenfold in terms of sustainability linked bonds. It's not just bonds that can have sustainability linked mechanisms. Bank loans can do that as well, and you can see the growth in that as well. So a very hot and popular market, trying to link the sustainability side with the credit side. So again, more examples then of the type of ESG type of targets here, and an example from Lafarge. What are the size of these things? It can be 25 basis points, 75 basis points. The question may be, well, let's talk about materiality then. Is it really notch worthy? Certainly 25 basis points or 75 basis points on one particular bond when an issuer has, let's say, dozens of bonds, probably not material. Now, let's say it then, upon several rounds of refinancings, they changed most of their financings to sustainability-linked bonds. Well, at that particular point, it does become material. So, one sustainability-linked bond among a whole portfolio of types of financings, probably not. But once it gets to a fairly large component, then it can have that type of impact. What sort of KPIs have sustainability linked bonds been attracted to? Well, typically they have been on the environmental side. A few of them have been on the social side and governance side. But what has been most popular has been linked to environmental factors. Okay. And lastly, I'd like to talk about one that we know fairly well. It's Enbridge. Enbridge is a North American pipeline company. It does issue a lot of different bonds, but we want to talk about one specifically that was done in September. $1.1 billion of sustainability-linked medium-term notes, interest rate of 3.1%. And they had two testing dates really in terms of potential step-ups. So in 5 years' time, there would be a test, and if they did not meet a certain percentage of racial and ethnic diversity targets, that would cause, and then also not just in terms of their workforce, but also in terms of women on their board of directors. If they did not meet those targets, then their interest rate would step up by 10 basis points. Then in 10 years' time, there would be another test. And this would be about greenhouse gases and whether they can meet a certain target with respect to their greenhouse gas intensity. So what that means is intensity as opposed to an absolute greenhouse gas emissions. Greenhouse gas intensity is more about emissions per amount of energy used. So if they didn't meet this target, their interest rate could potentially go up by another 50 basis points. Okay. And then the use of proceeds, unlike a green bond where where the proceeds have to be used for sustainability purposes, these are for the typical purposes of refinancings and capex and general corporate purposes. Okay, so that is the presentation, and Thank you for everyone that has attended this. I'm now going to open up the question box. For better or for worse, I see no questions yet. I am assuming that is because everyone has been happy with what I've been talking about. Are there anyone with any questions here? No? Okay. I'll wait another second. Great. All right, if that's the case, then I'd just like to thank everyone for their participation here. Thank you for listening to me. Hopefully you found it interesting, even though I wasn't talking specifically about sustainability. And have a great day. All right, bye-bye.